Hello on this beautiful day, at least in Berlin. I mean, it's quite sunny today on this Monday, 7th of April. The reason why I'm recording this video is due to, let's call it what it is, Trump's politics impacting the investment markets in a negative way. And I thought I'll just create a video just to address the elephant in the room quickly and then, um, you know, to be able to reach a lot of people at the same time. And then obviously I'm open to like individual conversations, phone calls, Zoom meetings, personal meetings with anyone who wants to speak about the current situation and address it individually. In any case, what I wanted to quickly talk about is the current situation and how to, maybe address the situation. I'm not necessarily sure there is any action required. For most people, probably not. But nevertheless, even emotionally, I think it needs to be addressed. And that's, a good point to start, I suppose, is to consider the situation in two basically main ways. One is emotionally, and the other one is logically. And so, what you want to do is you want to differentiate between the two. And I say that not to say your emotions don't matter. They definitely matter. That's why you even have an advisor, right? Because at the end of the day, if everything was just purely logical, then I suppose like investing would be relatively easy. The emotional component is a relatively important one. And let's start maybe with the emotional component first. And that's relatively straightforward in the sense that, well, if markets are, reacting in a negative way to negative circumstances, then you ideally you still, even when you're emotional, you don't want to like basically react out of pure emotion and leave logic completely behind. But what you want to do is you want to assess, okay, am I afraid of losses so much that I would rather prefer to reduce my losses, understanding that in the long run I will reduce my gains also. Then if that is a trade that I'm willing to do because maybe I'm expecting my financial situation to be rather unstable, or because I know that I need the money that I have invested in the next months, or like months are like incredibly short, maybe let's even call it like potentially like 2 to 3 years, then at that point I feel like it is incredibly understandable if you decide, okay, due to emotional reasons, and me valuing stability in this time more than potential gains in the future, I want to shift my investment to be more defensive. So again, this is a big distinction to make, right? Because if you need the money like really, really soon, in the sense like, I don't know, maybe weeks, potentially like 6 months, or I don't know, even like a year or so. At that point, it might be a sensible decision to say, okay, since I'm going to use the money anyways, there is a chance that the market is going to drop so much that, acting today would be a good idea because I'll need the money in 11 months from now anyways. And there's a chance that I'll have more money if I just take out the money now. So at that point, you might want to take out the investment. But if you're like, okay, I still have time and I'm not, valuing gains so much, but I do have some time and I don't want to like completely be out of the market because, that is generally going to be when you have more time, the worst decision. Then you can basically find the middle of the road, so to say, and then make your investment more defensive. And how would you do that? Well, that's something that obviously it is something that needs to be addressed individually. But the way you would do it is by, taking the share of your money that is invested into stocks and to reduce the amount of money that is invested into the stocks, and then add things that are more stable, like commodities or bonds. And so you would basically stabilize your investment. You still have potential for losses at that point, but the expected losses at that point are a lot lower. The expected gains are also lower, but again, this is the trade-off that you want to do when you're looking at it from an emotional point of view, and then you're on the more conservative side, and you want to basically protect yourself more than you're looking to build like high gains, because again, if you don't have much time, then there's also not so much to create in wealth if the time is not long enough. Um, Having said that, if you look at it from an emotional point of view and you feel, that you're okay and you feel that conservative approach is not necessarily the one that is required in this very specific moment, you can just simply continue the way that you've been investing. If you feel like, you're even in a position where your situation is so good and you're so stable that you feel like, you could even be more aggressive even, then again, individualistic conversation to be had. Since again, no one knows exactly what the market is going to do over the short term. I wouldn't recommend to go fully, aggressive and then just, invest heavily all at once today because there is a chance that tomorrow is worse. But at that point, it might make sense to add to your investment. It might make sense to, um, yeah, to potentially like change the portfolio and to maybe keep the amount that you're investing as is, but to shift it slightly more into stocks. That could be interesting for one or two people. Yeah, and then having said that, from a logical perspective, from the basically perspective that is like relatively emotion free, I would say that the things that I mentioned regarding the emotional approach also somewhat applies, but to maybe give like one or two more additional thoughts regarding this. When I basically, you know, talk to you about your individual situation and ask you about your current financial status, about your life goals, and about like the expected changes over the next years, I always factor potential market crises into the actual recommendation, into the portfolio that I suggest anyways. So while I never know when something is going to go bad, and I never know what it is that might go bad, I know for sure that at some point something has to go bad. Um, and yeah, and it's just something that you have to keep in mind. And so when I choose the suggestions that I choose, I always factor in that we want to be set up in such a way that when the market is reacting negatively, that we are going to react, or that we're going to experience the negative impact also, but to a extent that it is as smartly factored in as possible. That doesn't mean that high losses aren't possible, but it means that in the long run, it shouldn't matter because we choose strategic companies or like strategic portfolios where there's companies that are expected to grow no matter what, as long as there is trade and growth of the human civilization, because those are infrastructurally relevant companies that provide energy, they provide technology, they provide goods and services that we're interacting with on a day-to-day basis. And so this is basically one thing to keep in mind from a logical perspective, like we've factored this in that there will be bad times. And then there's the perspective that is also relevant is to look at your overall setup and to check, okay, like do I still have like an emergency fund? And how high is that emergency fund? Is it minimum two net salaries, maybe even three, or even a lot more than that? Because at that point, if I also don't need money incredibly soon because my income is stable and my employment status is unlimited, so I don't have like a limited contract that might expire, then at that point, well, if your company is also not like not going through like incredibly bad times, then, at that point, it would be a poor decision to actually hold the money in your bank account because, well, inflation is also, while, the stock markets are not reacting positively, but inflation is also expected not to, go down with this situation. And the idea is if you have the money on your bank account, where it is not going to create any type of value in the long run. While the markets are reacting negatively, it might seem stable in the short run, but you're going to lose out due to inflation, and you're also going to lose out because at the end of the day, you don't potentially need as much money on your bank account because you already have an emergency fund that is 2 to 3 net salaries, potentially even a lot more. Because, I mean, again, when I talk to most of my clients, individual situations obviously might vary, but most of my clients, I don't, when they have a lot more money than 2 to 3 net salaries, I don't recommend to invest as much as basically is left over. I usually tell people to start with an amount that feels like, even if it got lost, maybe I'm not using those words exactly, but the idea is even if this money got lost, then, it shouldn't, I mean, it would hurt emotionally, it would definitely suck, but it wouldn't be the end of the world, right? So you never want to invest in such a manner that like your short-term financial security is dependent on it. And so again, to maybe summarize this, from an emotional point of view, if you want to reduce the potential for losses, it might make sense to have an individual conversation and to adjust your investments. But from a logical perspective, these types of situations have been factored in the past because while, again, it wasn't clear what was going to happen, but it was clear that something was going to happen. So I, from a logical perspective, always factored, crises into the choices and the suggestions that I've made. And then it also, assess your individual situation and your financial setup, please. And then, if your short-term security is there, be aware of your emotions and your emotional state, and then come to a logical decision how you want to act in this situation. And yeah, let's have an individual conversation. Let's have a phone call. Message me on either WhatsApp or give me a call, give me an email, drop me an email, and then we can sit and talk about the situation individually. Hope this helps at least like a little bit to give some perspective. I hope you're good. I hope while the markets are not acting positively, your life is incredibly well and developing in the right direction. And keep in mind, negative market situations are not forever. They always recover. So yeah, that's all for now. I wish you, like I said, a pleasant pleasant week, and then talk to you soon.